What's going on, guys, and welcome back to the channel. The portfolio today is not doing too bad. As you can see, I sold out of the AMD play for a nice $28 gain. Also, I've been trading the SPY today as it had slid down a little bit during the trading day before popping, and we were up $51 on that. However, it hit my stop loss, and it went a little bit above my stop loss actually, or below my stop loss rather, and we only profited about $19 on that. We are up $24 on the day. However, if we wouldn't have made those trades, we would be negative around another maybe $18 to $20. So one kind of weird thing I did notice was the fact that about an hour into the trading day, Wynn Resorts had a massive volume boost and price spike. I really couldn't find any news surrounding it. I looked for 30 minutes trying to find any sort of cause of what caused this sudden jump in price. It has come down back down since then, but if you guys saw any reason as to why that spike happened, if you found any news, just post it down below in the comment sections, because I'd love to know why. So guys, I actually have done some selling today. I did sell out of 10 Microsoft shares, 5 Facebook shares, 10 Wynn shares, and 15 Carnival shares. And I actually did pick up 1 measly Boeing share. The reason I'm doing so much selling recently is just because of how overinflated the market is. The market has gone up in the last 3 months a little more than 10%. And in the last year, it's almost gone up triple that. And some stocks like Apple have gone up more than 100% in the past year. That is absolutely insane. Now we have to ask the question, are stock prices really that overvalued? Are things really getting that overpriced? In order to do that, we have to take a look at the PE ratio of the S&P 500. The PE ratio on the S&P as of today, January 10th, is just around 24.56, just surpassing the December 2018 highs when the markets had that 18% correction. The average PE ratio is around 20 to 21. However, if you take a look, we are actually within 1.5 points of being to the 4th highest that the S&P PE ratio has ever been. Even though the PE ratio, otherwise known as the price to earnings ratio, is quite high, that doesn't necessarily mean that stocks are going to crash. There are a lot of other factors that come into play. For instance, the news that surrounds the markets has a huge factor. If there is enough good news, for instance, like the confirmation of a trade deal between the US and China that's been reached, or simply the fact that we're not going to war with Iran, the markets will absolutely eat that news up. For example, just this past week on Monday, when everyone thought we were going to war, the futures were down almost 2%. However, after the news was digested a little bit, and more news started to emerge that there wasn't really going to be a war, the markets soared up from the lows on the futures and ended the week a little less than 2% up. Now, all the good news surrounding the market is really great. However, there's going to be a time where the turn happens, and it's going to fall 5, 10, 15, maybe even 20% down. You have to make sure that you're positioned for that. And how you become positioned for that is not to become too cocky. I can't tell you how many times I've said when I first started in the markets that it was super easy to make money when everything was going well for me, and then the next day I had a huge down day. Now, there are a couple of ways you can prepare for a market downturn or correction. One is to start and load up on cash, and this means you may have to start selling some of your stocks. During this time, I would not buy any stocks unless they are undervalued. The reason you want to load up on cash is because when that correction does happen, you will be able to put your money back into those stocks that you sold or find other undervalued stocks, and you will be able to get a better price average. I'm going to add that doesn't mean you have to sell out of all your stocks, because if you do and the stock market continues up, you won't know what to do because you may feel stuck or trapped into buying the stocks you sold at a higher price. What you could do instead is sell out of a couple, maybe 1 or 2% of your overall portfolio each week until you get around 30 to 40% in cash. The percentage you have in cash doesn't really matter as long as you have more than 25%. It really just depends on what your preference is. What I like to do is have 30 to 40% in cash. However, also if I make money from my actual job and it starts to get more toward that 50% in cash, I try to find undervalued stocks or stocks that have been just pummeled by bad news recently. For example, this is the graph of Boeing, which as of late has not been performing the best due to a lot of negative news surrounding the stock. The stock is a little more than $30 away from its 2-year lows due to this, and that's why I've been ever so slightly buying more and more. You have to understand that this is not always going to be the case. Finding undervalued stocks in a market that we are in now can be very difficult, especially considering that there are so many stocks up more than 50% for the year. The second way to prepare for a market downturn is a little more risky. It requires a lot more patience, so if you don't have the patience, then this probably isn't for you. The other method is doing what's called hedging a position. What that is basically insurance if the market goes down. So if you have your original shares that you own, and instead of selling them, you buy put contracts, or you can short an asset in the market and bet against the market and sell once the market drops. However, if the market continues to go up, your profits will be less due to the profit of your shares you own not being as much because of that insurance bet. By the way, if you don't know what a put option is, I will post a video explaining what they are in the description. However, I would advise that before you do anything with them, you should 100% know exactly what you're getting into and how to use them, because they can be extremely risky and you can lose most, if not all of your money, if they are not used correctly. So I had told you earlier that I hedged my position for the portfolio today by shorting the SPY, which basically tracks the S&P 500. Now, a lot of people will say hedging positions is used with puts rather than shorting an asset. Even though this may be true, I'm still technically trying to have insurance if the market goes down by shorting, which is essentially selling an asset or stock first with the promise to buy back later. As you can see, I have made $19 today on that, so I really didn't make a whole lot because I sold out a little bit too soon. However, I wanted to make sure I at least made some money while shorting. And the best way to do this is to try to find some sort of negative news in the market, which sadly right now is extremely hard to do, considering the fact that all really the market wants to do right now is just melt up. So to try to counter this, what I have actually done recently is trade what's called a channel. As you can see, I drew lines on the tops and bottoms of where the stocks have bounced in between over the last couple of days, and they seem to form a channel. Now the idea is to get in a short position when it reaches the top line and to cover or buy shares when it reaches the bottom line. The real problem is that nothing ever works perfectly 100% of the time. So in order to make sure you still make a profit, you need to not get greedy and take a profit when you have it. Now I know this isn't a lot, but I was up a little over $60 on my short position originally and I didn't sell it. Instead, I made a stop loss set for a $20 gain, ensuring that I wouldn't lose money on this position, and it ended up hitting that instead of selling for a $60 profit when I had it. So I hope you guys like this video explaining how to protect yourself just in case the market has a correction in the next coming months. What you really want to take away from this video is that when the market is melting up like this, you do not want to act and feel like you are on top of the world, because that can all change in just one day. So guys, with that, please be sure to subscribe, like the video if you did, and comment if there is anything you want to ask me, or maybe even give me suggestions on videos you guys would like to see next. Thanks for watching, and I'll see you later.